And the all right. Welcome again to another Viking Capital webinar. We're going to be talking about trends in the market. We're going to talk about our team. We're going to talk about our latest deal, Park 33, which is on fire. People are really excited about it. And I can't wait to answer questions from all our investors, from prospective investors all over the country who are learning about Viking, people who've already worked with Viking, and people who've really been appreciative of growing their wealth with Viking as well. So guys, welcome Chris, welcome Judah, and I'm excited to see where people are calling in from. So if you would, guys, all those members of the webinar, please in the chat, put in where you're from. I'm putting in here, I'm from Northern Virginia, guys.
I mean, we've already had many conversations with, people interested in this deal, and we have seen responses from all over the country. So I'm really hoping the webinar kind of echoes that as well.
Yeah. Guys, we got people from all over. We got Brad from Franklin. I got Boise, Idaho. I got Gainesville, Florida, Vegas, McKinney, Texas, Atlanta, Louisiana, Indiana, Illinois, Reno, South Bend. Man, this is good. This is a well-represented webinar from everyone across the country. Austin, fantastic, guys. So, as people are coming in here, I just want to share a little bit of the economic trends that I've been reading, Judah and Chris. I picked up a couple of these reports from some of the top economists in the country regarding multifamily, regarding, current economic trends, real estate, commercial real estate. And, what I'm getting a sense of is really, the Fed has sort of paused their monetary tightening temporarily. And, they're going to reevaluate. And, we've seen 10 straight hikes in a row. So for the commercial real estate market, this is exciting because they're starting to see sort of a light at the end of the tunnel. And I think that the next Fed meeting will be very crucial to see if all this institutional money that's sitting on the sideline is ready to get back into the commercial real estate market. Some of the things we're also starting to see is the hottest real estate markets are in Florida, in Texas, but there is a propensity for a lot of these institutions to start investing in tertiary markets, such as South Bend, where our deal is. And Jude, I don't know if you know this, but some of the trends are in 2000, only 9% of institutions invested in smaller cities and tertiary markets. And Chris, in 2019, it jumped up to 31%. And in 2022, guys, it was almost 40% of their money was going into these smaller towns, smaller towns and secondary tertiary markets. So that's exciting to see, this where the smart money is going.
Yeah, if you follow the rent trends also across the country, whereas some of the primary markets, some of the markets that we love and invest in, saw really outsized rent growth over the last couple of years. And you see news article after news article that in today's market, the markets seeing the most rent growth are the ones that are the slow and steady ones that have seen the same increases year after year after year. Markets like South Bend, markets like some of the Midwest, they're just slow and steady. But steady is the key word. And mitigating risk is what we're really focusing on. And to have steady rent growth in the market, month after month, year after year, whether it was the high times or now people are maybe a little more reserved, that speaks volumes for a market. They can really continue their rent growth even in today's times.
And I think another really, important fact is that real estate cycles, are cyclical by nature, and being able to buy at these attractive cap rates when we're towards the peak, and knowing that interest rates are going to come down and cap rates are going to compress, it offers a really great opportunity to be active and find transactions that we can close in this area of the market.
Yeah, absolutely, guys. And then I want to make sure your audios are good. So lean forward into your mics, and so we can really deliver that powerful content to our listeners tonight. So, what debt remains a challenge for many people. And in fact, a lot of the syndicators, a lot of the investors, a lot of the people who've bought multifamily real estate over the last 2 to 3 years, they got some variable debt, and when the debt increased, the rates increased, it's hit their ceiling and they're sort of struggling. And so this is an opportunity for us as we move forward into the next couple of months and the next couple of years. But That's also why I'm super excited about this deal. We'll talk about why the interest rate is so special here. Now, that being said, there is a housing shortage. There's about 5 million housing shortage units. But the last couple of years, because of, the sort of the popularity, the rent growth, all that, there's a huge surge in construction. The interesting thing I've noticed is because construction loans are so hard to come by nowadays, there's actually an abrupt stoppage of a lot of that growth that was supposed to come onto the market. And so I still think there's going to be a shortage overall. And then the final thing I want to sort of talk about is what is happening to our baby boomers, these sort of retired affluent baby boomers. I'm referring to specifically the millennials and the Gen Zers. Guess what? They like renting, and they're going to keep on renting for whatever reason. So that is an interesting trend to note. And then the final trend is, I was recently in Europe. I was visiting Greece and Turkey, and I noticed, the euro and the dollar are having parity. This has been going on for the last 6 to 12 months. This is unusual in the history of the euro and the dollar. And the reason for that is, I think the dollar is strengthened compared to the euro, and it's because the European central banks have not curtailed inflation as much as I think the US banks. And so you're going to start seeing investments from Europe into, I think, the US. We're seeing, we were on the phone, Chris, me and you, with all the Brazilian investors the other day, and there's such a huge demand from them because of the unstable currencies in their own markets in South America, and they're trying to come to the US. So these are sort of the global trends. And, I was sort of giving you guys an overview as all the people are coming into this webinar. So now that I think we have a good attendance rate, I'm ready to rock and roll. Are you guys ready?
Yeah, let's get started.
All right, let's do this. So guys, welcome to the webinar. My name is Vikram Raya. I'm one of the co-founders of Viking Capital. My background is not typical real estate, though I've been investing in real estate since 2008 for almost 15 years. I'm a cardiologist, and I had a passion for real estate, and I was doing it for many years. And I partnered with one of my buddies, Ravi Gupta, and we started Viking Capital in 2015. And it's been just an amazing journey. We did it because we wanted to figure out how to create freedom, time, flexibility, and alternative streams of passive investments for us and our families. And we started helping our friends, our colleagues, other people we knew in our network, and pretty much it's spread to it becoming a full-fledged boutique private equity firm. And we've had the pleasure now of working with thousands of investors. We've been able to acquire almost $750 million of real estate, and we really have a mission to provide outstanding investments outside of Wall Street. We have a mission to impact the communities that we invest in. We have a mission to really educate our investors so they make the best decisions, whether it's with us or with someone else. And we're really on a mission to, create these freedoms for people. And with that said, I want to introduce my two team members here. Judah Fold, our Vice President of Acquisitions. Welcome to the show, my friend.
Thanks, Vic. Always happy to be here, kind of helping Viking bring these deals to all our investors and all the people who've shown interest in Viking.
Yeah, absolutely. And my other compadre is Christopher Paranello. He is our Director of Investor Relations, whom many of you know.
Yep, nice to see everybody. Thanks, Vic.
All right, let's go to the next slide. All right, guys. Before I get into the deal, I have to do a little bit of sizzle and spice. So let's see what it looks like as a drone video. Press play. right, next slide, please. Okay, guys, so that was our asset, Park 33. As you can tell, beautiful asset, great vintage, good location, and it's the second asset in South Bend where we already own. So I'm really excited to present this to you. But before I do that, a little bit about the team you're going to be working with. Viking Capital is a full-fledged real estate team that specializes in multifamily in emerging markets, in Sunbelt markets, in sort of the top tier markets in the country. And you know, we've built out this team because we really want to have that institutional quality feel, but we still want to have that personal touch. And so we have acquisitions, operations, finance, asset management, investor relations, marketing, investor concierge. So pretty much the tax, the legal, all of it. And it's so we can provide a high quality investment product for you guys. Next slide. As I mentioned, we've been busy over the last couple of years. We've acquired close to, you know, this will be getting us to that $750 million of assets. We're hitting the closer to the 5,000 unit mark in terms of the number of assets acquired, and we've done it over different geographies. Atlanta, the Texas markets, Dallas, Austin, Houston, San Antonio, Washington, D.C., Indiana, and we're exploring getting into the Carolinas and Florida. Next slide. Next slide. And something beautiful about this is just really the open density of the asset. And so the top 5 reasons why this really speaks to us is we're acquiring, you know, as I mentioned, debt is a challenge for many people in this market. So why not take most people's weakness and make it a strength? And that's what we did. We are acquiring this for a low fixed 3% interest rate. And with the blended rate we're going to get, that Judah mentioned, it's still sub 4, which is amazing. This is a Class A asset, core plus, but it acts like a value add because of some of the opportunities that are available. It is 96% occupied with a strong tenant profile. Some of the recent due diligence we have done has revealed close to $80,000 income per tenant, strong cash flow from day one. We already have a strong track record in Indiana. Our asset, Main Street, we've bought it I think year and a half ago, 2 years ago. It's already appreciated over $10 million in value. So we know what to do in this market already. And if we end up selling it, we'll have synergy, we'll have market share, and we'll have strategies to really deploy this. So next slide. And I'm going to let Judah now sort of walk us through sort of the investment thesis of why we decided to pursue this particular investment, Park 33, which is located in South Bend, Indiana.
Yeah, you know, as we've discussed on many webinars before, right? Our team, you know, files through 1,000 deals a year to find our 4 to 8 deals that we choose to bring to our investors. And each year in each market, we have to really filter through and decide, what are we looking for? What is the goal here? The theme right now is how to mitigate risk in what some people see as turbulent times or maybe uncertain times. If you know what you're looking for and you can try and mitigate those risks, you can really uncover the diamond in the rough, the good opportunities. And this checks really all those boxes. So to draw your attention, first of all, the cap rate. Cap rate is a measure of risk, rate of return, right? Over the last couple of years, you were fighting for a 4 cap, a 4% return rate. Now, right now, a lot of people will take anything with a 5 in front of it, a 5.1, 5.2. This one is a 6 cap, right? That's a higher cap rate that we've seen in the last 3, 4, 5 years. Additionally, that's despite its occupancy being high, it's being a stabilized, newer product, right? 2018 build. And this thing is almost brand new. But if you go to the 4th and 5th line, that's what really people here should really focus on, the debt service coverage ratio, meaning how much of a buffer is there between what the property brings in by way of operational income and the debt service you have to pay for the loan. We're starting out with more than 2.25, more than double. Again, go to the major agency lenders out there. They want to see a 1.25, maybe 1.3. They'd be thrilled with 1.4, 1.5. We are blowing those out of the water in terms of the buffer we have. And that's, you know, the buffer is what we then take home and get to share with our investors. So that's what really stood out to us. That's what drew our attention to this product. mitigated risk, lower debt, higher ratio of operational income to that debt service on a practically newly built asset.
Next. Next.
Now, one of the things that we've kind of been talking about, both in our last purchases in Atlanta, over the last probably 12 to 15 months, is the idea of flight to quality, right? There's no question, if you read the headlines, that pricing power has shifted a little bit from landlords to tenants. And the thesis is, and it's proven true on the assets that we own, it's proven true from all the market information that I've read, is that tenants will choose to allocate their top dollar to nicer product, newer product, larger units. They might not look at things on a price per square foot basis, but if a property is nicer and newer and they have a choice of where to put their dollars, that's where you're going to put them. Now, if you look at the first column here, got 9-foot ceilings. Vic mentioned it's a low density product. That's why you see all those beautiful green areas, spread out pool and hangout facilities that were developed. An institutional seller took care of this very well. You have in-unit access garages, and a lot of the garages are kind of not double wide, but double in depth, allowing people to actually put, I saw people with tool sheds in their garages, man caves. I mean, this is a great asset. And if I were attending this market, no question as to where I'd place my dollars. Moving over one, then there's the actual upside that's just inherent in the property as is. Leases have been trading out high. They've been getting 14% trade outs, more than $200 just by people signing new leases. Now, the seller here is a great seller. He was parking money that he made from a previous career into real estate, looking to just clip coupons. He wasn't looking to do anything except to maintain the highest occupancy possible, even if he was possibly leaving dollars on the table, just how he chose to operate. What that allows us to do is to come in, if you look at the value add strategy, the goal here is to raise revenue coming into the property without really having to spend any money, which is unusual, but really unique to this opportunity. The seller here was offering utilities, cable internet service, and valley trash service for free. Now, in this market, as well as many other markets, those are services that get billed back to the tenant. They chose not to bill them here because, again, they just wanted people to live here, and they didn't really push the opportunity that was in front of them. They've already started billing utilities, and by the time we finish our acquisition and take over the property, it'll be about 75% of the rent roll will be paying those utilities. But additionally, we'll then start charging back for cable. We'll then start charging for the valley trash. These tenants move anywhere else in the market, they're also going to have to pay for those services. That's revenue dollars coming in for expenses that the property is already paying. No Viking investment needed to do that. That's what we call low-hanging fruit, a low-risk, high-reward opportunity to raise revenue. Finally, on the back end of our ownership, phase 2, I would call it, is then we'll go in a couple of years from now, when these units start to become a little bit dated, and put in tech packages, put in a nicer lighting fixture throughout the units, and that's when we'll get another bump in rents for that upgraded unit. So this is a 2-phase, really kind of low-risk investment thesis. That's what really got us excited about it, and got us even more excited when we rewarded the property.
All right, next slide. So I'm going to introduce our Director of Investor Relations, Chris Paranello, who will talk us about the investment, about the returns, and the profile. Next slide.
Thanks, Vic. Absolutely. So most of y'all have talked to me before, maybe done a pro forma review. Viking has had these 3 classes in the last few deals. Class A is going to be your straight 9% preferred return. You get prioritization, which simplified just means that you're getting first access to cash before being reserve. And what you're giving up for that, for taking on a little bit less risk, is you're giving up the profit share in the end. The minimum investment for Class A is $50,000. Class B and reserve are going to follow the same structure, with Class B offering a 7% preferred return and a 70-30 profit share. And then reserve class, for folks that are investing a much more significant minimum of $500,000, are getting the added benefit of an 80-20 profit share and an 8% preferred return.
Great. Next slide.
So here, really what you're looking at is the capital stack. You're going to see exactly how much we contemplate in each class. So Class A, is about 1.5 million of the total amount of equity that we're raising. Class B, 9.8 million, and reserve 3.8 million. And then it's going through, our projections for equity multiple and average cash on cash. You have that straight 9% in Class A, so a 1.45x equity multiple over the 5-year hold. With Class B, you're going to expect a 1.6 to a 1.8x equity multiple. And with reserve class, you're getting 1.8 to 2. The average cash on cash is 6.2 for being reserve, and of course the 9% for that preferred return, where you are getting that prioritization.
Fantastic, Chris. So really, I want you to walk people through. Let's say they invest $100,000 for if they're doing Class A or Class B, or let's say they want to achieve reserve class and they want to get $500,000. Walk me through this. And I'll be honest, many people are like, hey, I'm supposed to get a pref of class, for Class B, let's say, what is it? It's supposed to be 7%, right? Or reserve class is supposed to be 8%. Why are we starting a little bit lower? What can you walk us through all that?
Absolutely. And that kind of shows you why Class A is really popular with folks. So the preferred return, the way that I like to coach folks when I'm having phone calls with our investors and helping them understand the preferred return and the equity waterfall, really what you're looking at for Class A is impetus on cash flow. You're getting that 9%. It's prioritized. You're going to expect on a $100,000 investment, $9,000 starting in year 1, month 1. So 9,000 divided by 12. Those are going to be your payments that you can count on, assuming that the project is cash flowing well enough to pay Class A. Now, one thing to note about Class A as well is, that if you're getting less than 9%, that means that B and reserve aren't getting anything. And that's how that prioritization works. With Class B and reserve, you do have a 7% and 8% pref respectively. However, the cash flow that you're getting is based off of how much cash flow is in excess at the property level. So we project these out year over year. So 5% in year 1, 6% in years 2 and 3, 7% in years 4 and 5. It's clear that you're giving up a little bit of cash flow during the hold period compared to Class A. But for that return, you're getting that extra $40,000 payout at disposition. Or in reserve, it's a little bit more significant because you're getting that 80-20 split. So a lot of folks get a little bit confused with the preferred return and the actual cash on cash distributions. But this is really how it breaks out. And really what I like to impart is, if you're someone that's going to be living off the cash flow, so you're 70 years old and you're investing $500,000 into multiple projects, and that cash flow is going to be paying your bills, Class A might be the best fit for you. If you're somebody that is maybe a little bit younger or is looking for growth and you're looking to double your money every 4 or 5 years over a 20-year span, B and reserve are really the way to go, because they're going to give you the stronger reserve. And the folks that get Class A, while they are getting, that higher cash, when it's all said and done and we go to disposition, that segment of the total capital stack that was in Class A really is capping them at 9% and offering an even stronger return for being reserve.
Okay, fantastic. All right, let's go to the next slide. So, what we've done with this sensitivity analysis is, look, we have a suspicion of where we think this is going to trade out in the next 3 to 5 years when we sell it. But we've also wanted to include to you, like, if you are more conservative or more aggressive than us, you can sort of see based on the cap rates where, this could end up trading. So the sale price, the IRR, the equity multiple, the average annual return. So if you are very conservative, you're thinking this is going to maybe stay at a 5.9% cap rate, and this is what the returns are going to be. If you think the economy is going to recover in the next 12, 18, 24, 36 months, then maybe you're thinking more like a 5.2, 5.1. So we want to give you more knowledge, more availability, more analysis, so you guys can make educated decisions. And again, the best way is to get on a call with our team so we can help guide you based on your specific situation and see if this, makes sense for you.
And
Next
that's one thing that I would just stress, looking at the sensitivity analysis, what excited us about the deal was that no matter where we went on our assumptions, aggressive, conservative, we were very happy with the return profile. And there are many, many ways that we can stress this deal by break-even occupancy, debt service coverage. We don't have enough slides to show all that to you, but we really would be happy to discuss it with you. So, definitely jump on a call with us, and we'd be happy to walk you through the many scenarios where you'd see kind of different ways this deal can flourish.
Awesome. And I think we purchased a sort of swanky new domain, so people can just type that in and get to us directly. I think it's vikinginvestor.ai. Is that right, team?
Yes.
Yes.
Okay.
Yes.
Fantastic. Okay, good. So let's talk about rent growth, guys. So is there rent, even if we do nothing, Judah, what's happening here? I see 1574 as sort of the average effective rent, but in the recent few 60 days, we've had some bump growth. Can you talk
It's
about
not
that?
all that uncommon. We see properties that have been focused on occupancy. When they go to sell the property and they have a brokerage team who's very savvy, and they come in and they look at the rent roll and they say, your rents are kind of at a certain place, but you could get getting more rent dollars if you just tried. And the seller wakes up and says, yeah, okay, well, let's give it a shot. They just start raising rents, but now they're in their last couple months of ownership. And out of 188 units, maybe only 20 or 30 have received those new higher rent amounts. So if we just continue, we can earn $25 per unit immediately, again, spending no dollars, just bringing the rents, which are below market, to the market level. And that's what the graph's really showing. It's a great opportunity. It means day one, we can start seeing some value adding on site.
Great. Next slide. Yeah, another picture of the property again. So I think I saw a comment saying, hey, there's only one pool, but it's a good looking pool, you got to admit. But hey, maybe we should do a second value add, create a resort pool in the back. Judah, what do you think?
Yeah, we'll get the tenant sentiments on that one.
All right, Chris, let's talk about it.
So
why is real estate so sexy? I think there's one word, it's bonus depreciation, and only real estate investors will get it.
Absolutely. Bonus depreciation becomes really powerful. We're in a step down process where this year we're still able to take 80% of the bonus depreciation that's created at the property. We have the preliminary numbers back. This property, Park 33, is going to produce around 45% or $45,000 with that example, $100,000 investment of bonus depreciation that's going to pass through to all of our limited partners. We hope that, it'll exceed that. That's a conservative number, but I would think, between 40 and 50% is fair, with 45 being a pretty strong target.
Fantastic. And guys, there's some, right now it's set to sort of expire in 2026, after 2026, but we're hoping that some of the legislation may change, but regardless, take advantage of it in the year that we have it, which is right now. So next slide. Let's go on to the debt, Judah.
Yeah, absolutely. So again, what stood out to us on this one, in order to be able to mitigate the risk, was the assumable loan, right? So right now, rates in the market, got my kind of rate sheet this morning from one of our lenders. You're looking at this type of asset, 5.8, 5.9% loans. Maybe you can get 5.7 if you're lucky. With most of the deals in the market being still somewhere in the low 5 cap range. Again, this one's 6, fantastic. But most deals are looking at negative leverage. Here, we're walking into a loan that's less than a 3.1% loan. Still with about 7 years remaining, a year and a half still of interest only. Granted, that's a little bit lower leverage, but this one is not leverage constrained. In fact, we can go up to 70% here. The supplemental loan blended will still be at or a little below 4, depending on where the market shakes out by the time closing is. But again, way better than we would do in the market, despite getting better than market pricing on a cap rate basis. So to get a higher cap rate and an even lower loan, we're looking at a cap rate that's nearly double the assumable loan. So that is very creative to the business plan. 23.1 million total with both the senior and the supplemental debt on top of the $33.25 million purchase price. That's near 70% leverage. That's the kind of leverage that we've seen in the past. That's the kind of leverage that best accelerates a value-add business plan.
Next. Yeah, we'll keep going. So you can see here, this is the examples of the clubhouse, really high end amenities, really, affluent place to live. And so really attracting the top quality tenants. We talked about the value add. It's a 2-tier value add. Judah mentioned it. It's really phase one is operational efficiencies. We just want to tighten the screws, run this very efficiently like a high level institution and not like a mom and pop, and really, optimize income first. And if we can, cut expenses, great. But we don't plan on trying to cut the expenses too much because we do want to run it well, but it's really optimizing income and operational efficiencies. And then within 24 to 36 months, we'll institute phase 2 of our intro value add, which will already have money set aside in an account ready to go. And at that point, we'll assess with our property management company what's sort of the best bang for the buck, for the least amount of input, what's the most amount of output we can get. And really right now we're thinking sort of a light value add interior to the kitchen, to some of the technology, the packages. This level of tenant profile, this is what they're looking for. And so with a $4,000 per unit renovation, we're hoping for a $50 to $75 rent bump. Next slide. A lot of times when we do our value adds, we're not able to really achieve the full, value add across the spectrum, just due to the size of the property, the amount of scope of what's needed. In this case, we're going to really be able to do 100% of all of the units, 188 units. Next slide. Okay, I'm going to let Judah sort of walk us through the financial analysis here.
Yeah, absolutely. One question that always comes our way, and we want to really make sure our investors understand, is what does it mean value add, right? We're going to adding value to a property. So the way that these commercial properties are all evaluated is by taking the net operating income and dividing it by the market cap rate. By increasing that NOI, or net operating income, that's how you add value to the property, and then you exit, in about 5 years. Here we already described to you the ways which we're going to do that. So we're going to start those operational efficiencies. We're going to be billing the tenants for services they're already receiving, just not paying for, and then eventually renovating, the units that are right now about 5 years old, which means that they were, designed about 7 to 8 years ago. When they're about 10 years old and appear to be dated, that's when we kind of renovate them for a fresh look and get the new higher rents in. Now phase that over 5 years, and you can see what's happening to our NOI. We're going from just over 2 million year one. By the way, it's less if you take away day one, and we're raising it to 2.665 million. That's a $650,000 increase in NOI. May not sound like a lot. When you apply the market cap rate to it, it's actually $13 million in added value to the property. And that slow but steady business plan is what comes across when you look at the financial analysis. So $600,000 translates to $13 million of value.
Okay, next slide. Yeah, keep going. All right, so you can sort of see just the overview of the property. You can pause right here. This is just some of the top things we wanted to talk about. 188 units, 2018 built, 96% occupancy, large square plans. The 6% cap rate is really intriguing for us. Not much competition for this level. And I think, Judah, when you're out there seeing the property during due diligence, you want to tell us about some of the competition that's coming, but they're essentially charging more, but not offering as much.
Yeah, there's some other multifamily property. This is a place where people want to live, but really nothing that comes close to touching the quality of this property. In fact, there is one other property, 60 units, under construction right now. I did walk that property myself. Looks very similar from the exteriors. The interiors don't look to be the same quality, and there are absolutely no amenities on site. No pool, no clubhouse, certainly no playground for the children or pet park for any of the dogs. So really an inferior product. So this is best in class, is poised to remain best in class, which will allow us to best capitalize on our business plan and attract the top renters in the market.
Okay, next slide. Just a quick sampling of some of the amenities. The fitness center, the playground. It's very unusual, to be honest with you, especially in the Southeast or the Sun Belt and other places, to have attached car garages that are private 2-year units. And we're starting to see this in sort of some of the Midwest markets, and it's very attractive, and people are willing to pay a premium for that. Obviously, this is a very attractive place. People want to hang out here, resort pool, business center, internet cafe, dog park. And so we're going to keep these as is, and as needed, we can optimize some of this. Next. The only suggestion is, as this pickleball seems to be getting more and more popular everywhere across the country, should we throw one of those in there, right? But in all seriousness, it is really an outstanding property as is. Next.
It's unusual to see a property of this size, only 180 units, with this robust of an amenity package.
Yeah. Next slide. Here's an example of the in-unit garages. Here's an example of the pool, the fitness center. They already have Peloton bikes and things like that. And, one of the things we like to do when we go do our due diligence, can you pause for a second, is we like to check out the cars on the property. And it sort of gives you just sort of a guesstimate of the kind of tenant profile. And, if there's beat up cars, not well taken care of cars, it sort of gives you, a red flag. And in this case, the cars were all nice or well taken care of, well maintained. And so we feel very comfortable with this. And then when we actually did our due diligence, I think Judah will get into that in a second, but the income level of the tenants was also reassuring. So these people are not going to be affected by a small downturn, a small recession, things like that. This is more of an affluent tenant profile that is living here by choice, renters by choice, not by necessity. Next. Yep, we'll keep going. I wanted to get into the there's lakes on the property as well, which is beautiful. Next. Okay, let's get into the rent comparison. Let's go ahead and do this, Judah.
Yeah, absolutely. Again, when I was in the market touring, they didn't just tour the property, you tour all the comps as well. And, checking out the greater South Bend market and the immediate, Goshen market, not only was it best in class for Goshen, but when you compare it to the other kind of properties in the greater area that could maybe attract tenants looking for these amenities, we are way more competitive on rent and pricing, which symbolizes the ability of this property to attract top tenants. Also demonstrates the ability that we have to grow rent, kind of the ability we have to draft and other properties commanding higher rents. This property is at $1.40 a square foot. When we look at the other properties that are built at similar times in the area, even our own property, we're getting way higher rents on a relative basis than this property. So we're going in with our own property, other nearby properties, knowing the runway that exists on Park 33 in order to get in line with similarly high level product in the apartment communities in the submarkets.
Next slide. Next slide, please. Next. Okay, we'll stop here. Judah, please. Go
Yeah,
ahead.
I mean, and this just kind of puts a nice, graph set to what I was just describing. I mean, on 1, 2s, and 3s, the opportunities really only grow. As I mentioned before, when you have a seller focused on occupancy and they're just looking to kind of get their monthly checks, they're happy when they get them. They don't want to push rents and risk maybe a dip in occupancy. But we are very confident, looking at the other properties, also with high occupancy, that the market will command either $150 pops on the 1 bedroom, up to $500 on the 2s, and even higher on the 3s. So again, we didn't underwrite anything near these numbers, but the market does support it.
So I guess I want to stack on what Judah's saying. The conservative underwriting is we're putting in maybe $50, $100 rent bumps at most, but you can see the delta that's available for us if we really wanted to go after and try to capture it. And again, we're trying to be conservative with our viewpoint, conservative in our underwriting, but there is room here. Let's go next slide. Okay, so quickly, I want to go through some of the details about the submarket and then some of the economic drivers, and then I want to get into really what it looks like to get started with investing with us. And then finally, I want to answer your questions because I know you guys have a lot of questions. I want to make sure we're able to answer them. So really, Granger, South Bend, a lot of these places are very fantastic places to do business, fantastic places to live, cost of doing business. It's becoming more tech hubs. Next slide. they have a diversified economy, manufacturing, healthcare, education, information, natural resources, mining, government. Forbes has talked about South Bend being one of the top 150 cities for job growth. These are some of the major employers there. Honeywell, Notre Dame, Norfolk Southern. So a lot of the major hospital systems here. Next. And Judah will discuss, so, why we feel so comfortable about this submarket is this is not new to us. And I'll let Judah explain.
Yeah, so in September of 2021, we purchased what was then called Main Street Village. Those of you who listened to that webinar, since rebranded Elevate on Main. This is a 400-unit property, also in the South Bend MSA, this one in Granger, and it has a lot of similarities to Park 33. Also, high income pocket. There are high incomes on site, and as a result, people pay their rent. Delinquency is extremely, extremely low. Also on Park 33, right? We just did our lease audit, meaning we reviewed every single lease file. We walked every single unit on the property, and not surprising for the working households, average household income is $91,000. That's very high for rental property. And that's what you get when you attract the best renters in the market, as did Elevate on Main, as does Park 33. Again, conservative underwriting. We just showed you the high rent increases that the comps prove out are eligible on Park 33. For Elevate on Main, we underwrote, I think, $225 premiums when you renovate units. We're seeing north of $300 premiums on site. We're hitting, again, outpacing our conservative underwriting. And as a result, as I mentioned before, we have increased the NOI already by hundreds of thousands of dollars, which has in only 2 years, less than 2 years, gotten us a $10,000 increase in valuation from a third party, a company.
So $10 million valuation.
Sorry, $10 million increase in valuation, which was done by a third party who came in on site to value the property for us. So we're very comfortable with the market. We have an amazing staff on site, Elevate on Main. They are going to be involved in Park 33 as well. That's part of the economies of scale of going into a market where you already have a presence. And again, when you find something that works, you look to rinse and repeat. So when we saw another opportunity in the submarket, a newer vintage with a lower risk profile, but also upside, we are looking to execute very similarly.
Great. Next slide. Just a picture of Notre Dame, and I think some people are asking how close it is. So obviously it's a lot closer to our first property, Elevate on Main, but it's within I think 45 minutes of driving distance to our second property, Park 33. You can see here it's one of the top universities. It's not cheap to go here. $60,000 per year, tuition, 9,000 students, a pretty good acceptance rate. Next slide. And there's many other institutions besides Notre Dame as well. So next slide. So strong submarket demographics, about $80,000 household income around with a 5 square mile radius. But our due diligence showed about $80,000 on property, which is even amazing. 50% of the people in the area have white collar jobs. So it is a really different kind of market than some of the markets we've seen in Atlanta and some of the Sun Belt markets. And it really bodes well for stable tenants and stable rentership.
And if I can just stack on that 1 second, Vic, when we came into the submarket, 80,000, which is on the screen now, that's the household income in the submarket. When we did our lease audit, we were pleasantly surprised to find the working households at 91,000 average on site.
Oh, 91,000, better.
That means that this property is actually attracting not just the best tenants in the tenant market, but the best residents in the market, period, which is unusual, which is very exciting to see.
Great. Next slide. Again, just to emphasize, this is a heat map based on income data, and the darker the blue, the more money. And you can sort of see where the income is situated. And it's pretty much all over the different submarkets that we're looking at. Next slide. This is just an emphasis again on the educational institutions that are surrounding our asset. Indiana University, Purdue, Indiana Tech, the Goshen College, and assorted other colleges. There's about 35 colleges and universities around. Next slide. I think this slide gets a little sticky there. Okay, aerial view of the property. So you can clearly see, and I think there's when Ravi, my co-founder, was touring the property, he noticed really nice homes right in the back side of the property, nice employment nearby, nice shopping, nice retail. And so this is all the things that we look at in our analysis of choosing a good asset. Next. One of the coolest things I like about this asset is, yes, it's in a secondary/tertiary market, but it's located close to large employment centers, large transportation hubs, large metros, and major drivers of economic growth. For example, Chicago is only only 100 miles away. Indianapolis, 160 miles away. Toledo and that whole Detroit market, only 100 miles away. And so there's already huge institutions and educational hubs. I'm going to talk to you about another major manufacturing employer driver, but all of this is also very attractive. Next slide. So some of the industries here are agriculture, biotech, logistics, and healthcare. Next. 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 Go next slide. So I wanted to focus a little bit on the manufacturing. This South Bend Elkhart area is considered the RV capital of the world. So 80% of the world's recreational vehicles are manufactured in this small area of Indiana. Next slide. And the reason why this is important for you guys as investors is, how does that influence, the kind of employment, the economic impact of this MSA, this submarket? Well, this RV industry is $114 billion impact. There's $20 billion of RV sales, 600,000 jobs in and around this area. There's almost 500,000 RVs made every year in the US, of which 80% is made in this submarket of Indiana. Outdoor recreation accounts for 2.2% of the US GDP. So really it's huge. Now the question really is, what happens if there's a recession and RV industry is affected? Well, they've learned from the 2008 recession, and so we stress tested this economic driver, this kind of economic thesis, and they've diversified in other types of manufacturing. So yes, they manufacture RVs, but they actually do other types of manufacturing as well. So it doesn't matter what is needed; it's become just a large manufacturing hub.
Next. Yeah, a lot of the industries that support the RV industry and have grown on their own all exist here also. The electronics, the entertainment parts of the RVs, they've all flourished in the submarket, and it's kind of become a second home to all these other cottage industries as well.
When we look for markets to invest in, we look for these kind of things. We look for places that attract institutional capital, government capital, private sector capital. There's $22 billion of capital coming into Indiana. There's industrial development. There is a limited supply of housing. There's a housing shortage. There's also, we like to invest in landlord-friendly states because we want to, run these multifamilies in an efficient way. We look for high bond ratings for the city, so they're not charging high taxes. And I think Judah can mention a one-liner on the taxes quickly as well. And then we look for job creation. There's a 250% increase in job creation year over year, and obviously close to major transportation hubs and metros. But Judah, you want to mention a little bit about the taxes?
Yeah, absolutely. Unlike a lot of other states, Indiana has passed legislation restricting the counties and the towns and cities from what's called sale chasing. I mean, every time a property sells, just reassessing it at that really new higher value. Most usually when you underwrite, you see there's a cap rate that we mentioned, and then a tax adjusted cap rate, because your earnings will just kind of drastically fall off a cliff once the county reassesses for taxes. Indiana counties are barred from doing that. they have to wait till there's a trending direction of similarly situated assets before they can really raise the rents. And in a market like South Bend, there aren't nearly not as many multifamily properties as there are in New York City or in Phoenix or in Chicago, and therefore it takes a lot longer for those trends to take place. We've underwritten the highest estimate after talking to tax professionals of what that could be. But again, it's a much slower tax increase and a much lower rate, which enables us to really capture as much of that value that we're adding instead of just raising all the value simply to pay taxes. So a really advantageous benefit of investing in Indiana.
Next slide, please. I think we've talked about this. Next slide. Great. An interesting side note, it's become a startup incubator. And so there's a lot of tech support, a lot of biotech, a lot of private and public partnerships that are happening in here, and a lot of entrepreneur base. Next. So really a diversified economy, multiple sectors of growth in the South Bend market. Next. So now let's start talking about Viking Capital. So, you know, these are our current assets under management. As I mentioned to you, we've done 24 transactions throughout our history, and we've done every type of debt deal. We've worked with so many different kinds of sellers and buyers. We've earned a strong reputation in the industry, and we really earned loyalty from our investors. And it's really because we're investor centric. We really care about our investors. We want to, you know, really help them achieve their financial goals. Next slide. And I think we've done a reasonable job at doing that. With these are our exits, and we've achieved an average annual return to our LP investors of about 24%. And this is us exiting about 2,000 units with an average hold period between 3.5 years. Next slide. And again, we'll emphasize the deal that makes most sense as it is in the same submarket and has a similar sort of MO to this Park 33 deal. Judah?
Yeah, and I kind of spoke about this one before, but again, we just have kind of gained an expertise in the market. We have staff in place ready to go. Again, that one's 400 units, a much larger operation than Park 33. We'll be able to seamlessly add Park 33 with an economies of scale in order to really just hit the ground running. Whereas in Elevate on Main, we had to come in, we had to build the staff, we had to build the vendor list, we had to get every the wheels in motion. Park 33 is going to come in with all those already in place, ready to just execute on the business plan day one.
Next slide. So our two other properties we just recently acquired are Elevate Green and next slide. Elevate Eagles Landing. And so congratulations to those investors who were part of those deals. We're really excited. And we've really been active despite the challenges we're seeing in the markets. And we're very judicious and cautious in finding deals. And so we do try to find the needle in the haystack, the diamond in the rough, you know. And this is what we're doing. We're going to go through 1,000 deals, 1,500 deals, 2,000 deals to find those few deals that make sense, meet our strict acquisition criteria, meet our investment thesis, so we can help our investors achieve their financial goals. Next slide. So with that said, guys, there's a QR code here. We got that. There was at vikinginvestor.ai. There's phone numbers probably popped into chat. But at this point, I want to discuss, what's going on here with the Q&As and answer questions. So let's get to it. Judah, you ready?
Yeah. One question that came in, which I would love to quickly address, is if the property was built in 2017 or 18, why spending so much to refurbish? So what's unique about this asset, unlike our other properties where we've kind of come in day one with $18,000 budgets to redo interiors that are 20 years old, this is a 2018 built property. Now that means that they broke ground in 2016, which means they got permitted in 15 or 16, which means the architect started working on it in 2013. So in actuality, you have a dated 10-year-old kind of looking unit, but it's in great condition. In 2 years from now, that'll be, again, 2 years more dated. and our budget's $4,000. We're not looking to spend good money after good money that the seller has spent. Instead, we're looking at, like I said, operational efficiencies, bill tenants for the services that they're already getting, and then put in $4,000 for a tech package, for upgraded LED lighting fixtures, things that the tenants will come to expect by that point from a quality of this stature in order to really command that top rent dollar. So it's not a refurbish. It's not the same level of renovation you've seen in our other properties. This one's a lower risk, lower spend, but still a great opportunity.
Yeah, I'd call it just a light value add. It's sort of like a refresh. And the thing is, this is only going to be validated by research and data. So if we see the tenants, when we can do it where we test a few units, if it yields the rent we're desiring, then we do it full-fledged. So we're very cautious in how we sort of roll out these investments. Okay, next question is, let's see, how far is this from Notre Dame Stadium? I think it's 45-minute drive. That's the next one is, I received an email that Class A is full. Is that so is it full, whereas we just joined the session to okay. So he's wondering, is Class A full? So I'll let Ravi sort of help weigh in on that. Ravi, our co-founder, welcome to the show, my friend. Thanks for joining in.
Yeah, thanks, Vic. Thanks, everyone. It's a real pleasure to be here. Can you hear me okay, Vic?
Yeah, absolutely.
Okay, great. Yes, so happy to answer any and all of these questions. So Class A currently it is full. We had a large interest. We have large interest in this deal anyway, but Class A, as Chris mentioned earlier, is one of those classes where people very much gravitate towards. So that one is currently full. But Class B has plenty of space, but it is filling quickly. So I really recommend that if you're interested in this deal, please book a call with us. Go on to these multiple sites that Vikram mentioned, and you can get more information on how to invest.
And the other class that's filling up is reserve. So yeah, it's I just think there's not that much investments out there really that sort of fit a lot of the criteria that this does, and so that's why I think this investment is gaining a lot of traction. So great.
One question here by investor about what does a hold period of 5 years means. A hold period means the investment period. The way it works here in kind of our value add strategy is that, if you remember earlier in the slideshow where we showed you how we expect to create $13 million of value by increasing NOI by $600,000, that $600,000 comes from the value add strategy. By billing back the tenants for the services they're already getting, by then doing that phase 2 and raising the rents. You can't do those strategies in perpetuity. So what you do is you come in over the course of 3 to 5 years, you implement the strategy, you get that kind of increase, that steeper curve of value add before it would eventually level off. We look to then sell it when it's leveled off and fully stabilized for an owner who wants to come into a well taken care of kind of steady asset. And then we'll redeploy those dollars to the next deal to get back onto that steeper value add curve. So the holding period is simply the investment period. And that's really when you can create the most value for investors.
Arun is asking questions about, hey, I know there's investments out there that, are holding distributions or pausing for whatever reason. And usually those are investments that may have had, variable debt. That's one of the reasons why we love this property in this part of the economic cycle. It is fixed, stable debt. There's going to be no surprises on this deal at all, because we're buying it essentially at sort of the toughest time in the economy, still performing well, still occupied, still has cash flow, and the debt is stable for a long period of time. And so that is why we feel so excited and intrigued to bring this kind of stable core asset to you guys.
Yeah, and if I could just add to that, Vic and I were discussing this asset prior to being awarded it, and we haven't seen positive leverage like this in many years. So positive leverage meaning that the interest rate on the loan is less than the cap rate. The cap rate on this deal is about 6%. The blended interest rate is just approaching 4%, just under 4%. So that really bodes well for the property, and it bodes well for the overall investment. And when we started Viking Capital way back in 2015, we were seeing deals like this, but it hasn't been that way for many years. So we're really excited about this time where we can find deals like this that make so much sense.
People are asking the question of what does a 5-year hold period mean?
Yeah. And yeah, there's another question about how you know the money's secure as well, along with that. So the 5-year hold period means that, you know, this is the life cycle of the deal and how long we intend to hold it. There are certain sponsors that'll cycle through deals very quickly, like 2 years. You know, they'll do some heavy value add, sell the deal, and then go on to the next one so they can recapture that equity. Our hold period is 5 years. And that's pretty much standard in the space. So many people hold for 5 years and then underwrite a 5-year hold. But if the market allows us to sell earlier and we hit our metrics earlier, we'll sell earlier. If we need to hold it longer for whatever reason, we can hold it longer. The beauty of this loan that we have is that it does have a longer term remaining on it. Judah, and correct me if I'm wrong, but it's 7 years remaining currently. So we can sell it early, we can hold it longer, and that's, you know, it's up to us and how the deal is performing. Another question somebody asked was that I want to answer is, how do we know our money's secure? How do we know, you know, Viking Capital is what Viking Capital says it is? You know, this question made me smile because I just finished a podcast about this, where there are, you know, certain Ponzi schemes out there and people are asking for money and reinvesting it or giving it back to investors and things like that. But call us, you know, ask us the details of the underwriting, ask for references, look at our track record, talk to third parties that we use and make sure that, you know, we are indeed what we say we are. It's always good for you to feel comfortable and investing with a sponsor that you feel comfortable with. And many people are referred to us by friends of friends, and you know, it helps them feel comfortable that way too. So there's so many ways you can make sure that you're investing in the right sponsor. In this case, you know, our track record, third party people that we third party consultants that we contract with, and our experience makes a lot of the difference.
Yeah, and I'll also give you an example, like companies like Blackstone have put us on as the preferred buyer. We're on the preferred buyers list. I mean, we've earned credibility from, you know, top level institutions like CBRE has us on our preferred, you know, buyer list. So it's hard to get to these levels unless you really sort of gain trust. And I'll be honest with you, more than you guys who I care about, I mean, I have people who are my family members who invest in these deals, and so you know, we have people who we care about deeply who invest alongside it. And me and Ravi also invest our own hard-earned money into these deals. So we fully believe in this. This is not a you know, investment scheme. This is an investment. This is what we really believe to help ourselves create wealth and our colleagues and our friends and our family. After 7 years, what's the adjustable rate? Or what happens after 7 years, as people are wondering?
So there's 7 years remaining in the term of this loan. So either we have to refinance in 7 years if we decide to hold it longer, which is very doubtful. But if we do decide to hold it longer, we have to refinance or we have to sell.
Yeah. We, on average, you can see we've exited, I think, 6 or 7 deals. Our average hold period is 3.5 years. So, you know, likely worst case scenario is we hold it for the full 5 years hold, and we sell at that time. But it's nice to have that buffer, that cushion. So we're not forced to sell, but we get to choose when is the optimum time to sell. And what we're looking for when we're trying to sell is, let's maximize our investor returns. Let's see, are there any deals located in Nevada? No, we don't have any deals in Nevada. We've looked in places such as Utah for some projects, but nothing yet. Minimum money is 50,000, Rajkumar. All right. Anything else? North Dakota. No, we don't have anything in North Dakota. Worst case scenario. What's the worst case scenario? Worst case scenario is.
So I'd love to answer that question because I get it all the time. And again, I just recommend, you know, we'll do our best, and we got to be respectful of time here to answer everyone's questions. But I highly encourage you to pick up the phone and call us. Vic and Robbie will tell you this themselves. There aren't a lot of owners who will be making themselves available to be on the phone with investors. Call our team, speak to Chris, speak to myself. In terms of worst case scenario, one of the benefits of that value add space is that when you invest in a ground up project, and I'm not saying there aren't ground up projects to invest in, but if something goes wrong in a ground up project, you're stuck with a piece of land, some dirt that's not producing any income. This is a 2018 built property, 97% occupied, that's generating revenue on a monthly basis. That if we just buy today and do nothing, we'll return 6% every single year. We're buying it at a 6 cap. The loan, the newer vintage, the well-maintained state of the property the sellers left it in, these are all ways to mitigate risk on what's already a reduced risk property. So again, we walk in, do absolutely nothing. There's a brand new property that's producing 6% return from day one.
Awesome. And then someone's asking, is it cash flow returned as income or is it a return of capital? I really would run away from places that actually give your capital back as cash flow. So your capital or your principal is returned to you at sale, and that's not considered return of your is not considered cash flow. The cash flow is coming from the property itself. That's what's generating your cash flow. And then we create profit because we have done a value add. And so that creates the profit. And then you get your return of capital, your principal. So it's really cash flow, appreciation, return of capital, 3 pieces there. And then if I had to throw in a 4th piece, it's tax benefits. It's the cost segregation yielding the bonus depreciation, which you're going to benefit from year 1 and year 2. So, okay, I think that's it, guys. So
there's one more question, Vic, that I can answer. What are the tax implications on individual investors? So we discussed this earlier in the webinar, but this is one of the main reasons people invest in real estate, because there are tremendous tax efficiencies. So if you invest either as Class A, Class B, reserve class, you will get a K1 at the end of the year, which will show paper losses. So these aren't real losses, but these are paper losses, meaning that you can use those losses to offset any passive gains that you have with any other investments. So we've had deals in the past where an investor would invest $100,000 and have a loss of $100,000 that they can use to offset any gains.
it was a paper loss.
Is a paper loss, yeah, not a real loss. So tremendous tax efficiencies here. And many people invest just for that reason alone.
Yeah, and that's why we have so many high income power earners, high income professionals, physicians, lawyers, architects, dentists who invest with us. How many properties have you experienced with? Well, we've done 24 multifamily deals, in our tenure. So that's our track record. You've talked about the tax implications, and I think that's it, guys. So
Closing date.
Yeah,
The closing date.
So the closing date, Judah?
Yeah, sure. On this kind of deal where you're assuming a loan, you're a little beholden to the master servicer. So we're looking to close anywhere probably from 60 to 90 days from when we went under contract. So within the next 2.5 months is when we anticipate closing.
Okay, awesome, guys. And any more questions, we're available. There's so many links to get a hold of us. There's the QR code here. There's vikinginvestor.ai. There's emails. There's booking links. So choose one of these things, get a hold of us. This deal will probably sell out. It will be oversubscribed. I want you guys to get into this. It's hard to find deals like this. Trust me, we've been looking for years. So take advantage of it. Let's go. Let's rock. We'll see you guys soon. Okay. Cheers. Have a good night.
Thanks, everybody.
Thanks, everyone.